Welcome back to Jackalyze, where analysis meets instinct. Today, we're talking about one of the most important concepts in economics and trading: inflation, the second golden brother. Whether you trade currencies, run a business, or manage your household budget, understanding inflation is essential. This video breaks it down plainly: what inflation is, how we measure it, the different kinds, which are healthy and which are dangerous, and what to watch for in the economic cycle. Let's start with the basics. What is inflation? Inflation is simply a general rise in the prices of goods and services over time. When prices go up, each unit of currency buys fewer things. Your money loses purchasing power. In FX and macro analysis, we track inflation over 3 windows: monthly, quarterly, and yearly. A 10% yearly inflation means something that cost $100 last year costs $110 today. Or put another way, last year's $100 now has the buying power of about $90. Next, let's see how GDP and inflation are related, the first and second golden brothers. Think of GDP and inflation as two siblings. When GDP rises, more spending, more production, more jobs, economic activity grows. That extra activity often increases demand for goods and services. If demand outpaces supply, businesses raise prices. Rising GDP can therefore lead to rising inflation. That's why we call inflation the second golden brother. It often follows the production and spending growth of GDP, and together they tell the story of an economy's health. But remember, more activity is good up to a point. Too much demand without supply adjustment leads to overheating. Here's a practical example to make it clearer. Imagine you own a phone shop selling Model Z for $200. You sell out every month. Demand stays strong, so you raise the price to $210, a 5% increase. People still buy, so you raise it again to $230. Now you're up 15% from the original. But sales drop to 50%. You've pushed prices past what the market will bear. This overinflation at the product level mirrors what can happen at an economy-wide scale. Businesses will keep raising prices only until consumers stop buying. Now, let's look at how we classify inflation. We'll do this in 3 useful frames. First, we consider intensity. How big is the inflation? Creeping inflation. Slow and steady, around 2 to 3% per year, generally healthy. Galloping inflation. Fast, double-digit annual increases, risky. Hyperinflation. Extreme, rapid collapse of money's value, destructive. Second, we examine the cause. What is driving the inflation? Demand pull. Too much demand versus supply, too much money chasing too few goods. Cost push. Rising production costs, energy, materials, wages, passed to consumers. Imported inflation. Higher foreign prices or weaker local currency make imports expensive. Wage inflation. Rapid wage growth fuels higher spending and costs. Structural inflation. Long-term supply problems, like ports or infrastructure. Core inflation. A measurement that removes volatile items, like food and energy, to show underlying trends. Third, we look at stability. How long does the inflation last? Transitory. Short-lived spikes, like a seasonal crop failure. Persistent or chronic. Lasts year after year, eroding value. Expected versus unexpected. Expected inflation is already considered in decisions. Unexpected inflation surprises savers and fixed income holders. Not all inflation is the same. Let's take a look at which types can be helpful and which ones are harmful. Healthy or good inflation. Creeping inflation, low and predictable, so people and businesses can plan ahead. Moderate demand pull inflation. Happens when demand rises, creating more jobs and higher incomes, usually a sign of a healthy economy. Risky or problematic inflation. Cost push inflation. Prices go up, but incomes don't. This can squeeze households and businesses. Expected inflation that becomes self-fulfilling. When people expect prices to rise, they act in ways that actually drive prices up. Galloping inflation. Too fast to manage effectively, creating economic instability. Destructive or bad inflation. Hyperinflation. Destroys the value of money and public trust. Persistent or chronic inflation. Slowly eats away at savings and discourages investment. Structural inflation. Rooted in deep economic issues, hard to fix, and slows long-term growth. Central banks generally aim for approximately 2% stable inflation, the sweet spot supporting growth while preserving price stability. Now, let's see how inflation moves with the economic cycle. Inflation usually rises during expansions and falls during recessions. Policymakers use tools like interest rates, fiscal policy, subsidies, and currency interventions to influence inflation. When it comes to demand-driven inflation, central banks may raise interest rates to cool spending. Cost-driven inflation is trickier to handle. Governments might use subsidies, adjust taxes, or implement supply-side reforms. So, what does this mean for traders, savers, workers, and businesses? Traders. Identify why prices are rising. Demand-driven inflation can signal a stronger economy and currency. Imported or structural inflation may weaken it. Savers. Persistent or unexpected inflation erodes real returns. Consider inflation-protected instruments. Workers. Wage negotiations should account for expected inflation, but beware wage price spirals. Businesses. Monitor input costs and consumer demand. Pace price increases carefully. So, inflation means rising prices. Your money buys less. Think about it in three ways: intensity, cause, and stability. Low, steady inflation is healthy. High, fast, or persistent inflation is harmful. Always consider why prices are rising before making any decision. At Jackalyze, we break down fundamentals so you trade with clarity, not guesswork. If you want a deeper dive, our next session will connect these inflation types to central bank policy and how that moves currencies and markets. Subscribe now. Patience of a jackal, precision of a trader.